How much does it cost to refinance a mortgage? Many of my clients are trying to refinance their mortgage for specific purposes. Maybe they have credit card debt, maybe they have some other thing they want to accomplish. Keep watching this video to find out all the ins and outs of how that works. In this video, we're going to discuss some costs that are associated with refinancing your home. We'll discuss some reasons why refinancing now may be a good option for you. And then I'll give you some insider tips on how to lower the cost of your refinance. All right, let's get to it. Okay, so there's several factors that can affect the cost of your refinance, but before we get into that, let's talk about the two main types of refinancing options out there. There's a straight up regular refinance, and that refinance is where you're just gonna roll in your current mortgage into a lower interest rate. So you're literally replacing one mortgage with the equity you have in your home with another mortgage. The second type of refinance, and this is by far the most common type of refinance, is going to be a cash out refinance. Now, a cash out refinance allows you to take out money from your home and refinance the money and the equity that you have in your home into a new loan. So as an example, let's say for simplicity's sake, you've got a $200,000 mortgage. And let's say that you owe $100,000 on that mortgage and you have $100,000 worth of equity. In most cases, you can borrow up to 80% of the equity that you have in your home. In other words, you can't borrow more than 20% equity. So let's go back to that $200,000 example, and you owe $100,000 on it. There's $100,000 that you can refinance back into your home, but you can only borrow up to $160,000 on that home and still have that 20% equity requirement in the home. So you'll have $60,000 worth of money that you can roll out of your home. Now, the higher you get to that 20%, the more you borrow out of your house, the higher rate's gonna be, and the higher risk assessed to your credit profile is gonna be as well. In terms of actual costs for your refinance, it depends on your location. And this varies wildly from state to state. You're gonna look at property taxes, appraisal costs, and other fees. In fact, your lender is gonna give you a loan estimate, and it's gonna have all of these fees clumped together and what that looks like for you. Another thing that you really need to consider is gonna be closing costs. In general, closing costs are gonna be 2.5% to 3.5% of the overall mortgage. So going back to that $200,000 example, let's say you decided to borrow $150,000. Your closing costs are going to range from 2.5% to 3.5% of that $150,000. So since the average closing costs are 2.5% to 3.5%, we'll just use 3% for the 160 example, the $160,000 example that we recently talked about. $160,000, and if you multiply that by 3%, that's gonna come up with $4,500 and some change, essentially. Now, this can be substantial. Let's say that you have a mortgage that you're trying to refinance at $500,000 or $800,000 or $1 million. 3% of $1 million is a substantial amount of money. So don't forget closing costs. It's not always just about interest rate. You might be able to get a lower interest rate, but if you're getting beat up on closing costs where you're having to pay $10,000, $20,000 on closing costs, you have to look at what you're gonna save over the next 15 to 30 years with the new APR, and if that makes sense. Now, if you're doing a cash out refinance, of course, it doesn't really matter. I mean, it does matter when it comes to closing costs, but you're really trying to pull out cash from your home. So the closing costs do matter for a cash out refinance, but kind of in a different way, because you're not necessarily just trying to lower your payment, you're trying to pull out money from your house. So in closing cost fee structure, there's all kinds of things that are included in that. There's gonna be application fees, origination fees, title fees, recording fees, and fees and fees and fees. There's all kinds of fees that are rolled up in your closing costs, and sometimes those are negotiable. And then there's what we call discount points. You actually have the ability to pay down your rate. Now, a full cost analysis is gonna be needed to really make a decision as to if this makes sense for you. As an example, if you're gonna buy down a $200,000 mortgage by let's say a 1/4 point interest, it may cost you 2 points, which means that you're gonna have to pay 2% on that $200,000 mortgage, which will come up to about $4,000 to buy down 1/4% rate decrease, right? So in some cases this makes sense, and in some cases it doesn't. In another video, we'll talk more about how this works. Okay, now let's talk about some good reasons to refinance. Obviously, the number one reason why people want to refinance is because they get a lower payment, right? And this is something that has been happening for years and years and years with interest rates being so low. Just a couple years ago, interest rates were 2.5%. I don't know that we've ever seen 2.5% interest rate on a mortgage. Of course, interest rates are going up now, so it's going to be more difficult to justify a refinance at a higher interest rate, unless, of course, you're looking to roll out cash from your home. If you're looking to roll out cash from your home, and you're taking a higher interest rate, let's say you're going from 3% to 5%, 5% is still a pretty low interest rate to pull out a lot of money from your home. If you were going to get a personal loan, that interest rate is going to be 8 to 15%, so it still may make sense for you. Another reason that you may want to refinance is because you're currently in a situation where you're in an adjustable rate mortgage or an ARM mortgage, and you want to lock in a very specific rate. And now you've come to the end of that period where you want a fixed rate. Usually ARM rates remain standard for 5, 7, or 10 years. And then at the end of that time frame, you may find that refinancing your mortgage is going to be the best bet for you. Many people will refinance because they want to go from a 30-year note to a 15-year note and save a ton of interest in the process. I don't think this is necessarily a bad idea, but remember, there are closing costs involved. So if let's say we have a $300,000 home, and we're refinancing to get to the 15-year mortgage instead of the 30-year mortgage. Remember, closing costs are going to cost you, $9,000, $10,000. In some cases, it makes more sense, instead of restructuring that mortgage to get into a 15-year note, it may make more sense to just pay more on your current note, therefore artificially making it 15 years less. And I'll give you an example. With my own mortgage, I pay an extra $1,000 every single month on my mortgage. And the reason I've done this is because I actually did the cost analysis of what it would cost me to refinance, and I didn't want to pay, let's just say, a lot of money in closing costs. I'd rather just put more towards my mortgage. Another reason why people will refinance their home, and this is very common, is they want to make improvements to their home, right? They want to put a pool in their backyard. They want to knock down this wall, and they want to add something else in their home. Maybe they want to buy some, really nice furniture, or maybe they want to build a deck on the outside of their home. There's lots of reasons why people will refinance their current mortgage. Paying down credit cards is another reason that people will refinance their mortgage, especially when it comes to your cash out refinances. That's the most common reason that I see people will actually refinance their mortgage and pull out money, is to pay down credit card debt. They got overzealous on their spending, and they've decided they're going to pull money out of their home to get that paid off. And the trick is to get that credit card debt paid off and then make sure that it doesn't happen again, right? Because what happens sometimes is we see a bunch of credit cards that have $0 on them, and they're looking all pretty and wonderful and empty, and we feel like we have to go spend more money on those, and then we put ourselves back in that same situation. A lot of people have pulled out, specifically in the last couple of years, money from their home, refinance their home because they want to pump up their savings. Again, interest rates have been historically low. If somebody has a $500,000 mortgage and they only owe $100,000 on it, a lot of people were pulling money out of their home and just beefing up their savings with it at 2.5% rate. You're never going to get money at 2.5% ever again in the history of ever. It may happen in the future sometime, but I don't predict that we're going to have interest rates like that for mortgages anytime soon. Maybe not even in my lifetime again. Some other reasons why people will refinance their home and pull out cash is to take a vacation, is to do things that they really didn't want to save money for. And I need to tell you that from my standpoint, and I'm not throwing shade or judging anything, I think it makes little sense to pull out money from your home for a situation that we really should be saving for. Now, everybody has their own budget. Everybody makes their own decisions for their family. And as I mentioned, no judgment here, but if the rule of thumb is if you can save for a situation, then it probably is not a situation where you should pull out money from your home. Why is that? Well, your home is always protected. So let's say that you're an entrepreneur like myself, or you own your own business, or you have a high-end job. Let's say any of those things end up kind of falling apart, and you're in a situation to where you can no longer pay your bills. Well, your home is protected. If you pull out all the equity in your home, that could be a situation where your payment is much more than you can afford if things kind of fall apart. Another way your home is protected is in a bankruptcy type situation. You can have as an example, a $500,000 mortgage and have it nearly paid off and have all that equity lined up out there. If you file bankruptcy, your creditors can't touch that. So just think about those things as you're considering pulling money out of your house. Okay, before I give you some insider tips on how to lower the cost of your refinance, please like this video and subscribe to my channel. I'll be working hard to bring you one video each weekday over credit lending, real estate, and other relevant personal finance topics. Okay, now here's some insider tips on how to lower the cost of your refinance. The first thing is you need to make sure that you're shopping for your refinance just like you would shop for anything else in this world. Really, every lender has their own fee structure, their own interest rates, and they'll give you a loan estimate. My recommendation is to go to at least 2 lenders and have them compete for your business. Well, is that ethical? You bet it's ethical. As an example, for myself, because of my credit standing, I never have to take a bad deal in any situation. When I go out to shop for anything when it comes to borrowing money, I'm gonna always have lenders compete against each other. And what I do, especially when it comes to a mortgage, I just bought a new home a couple years ago, is I'll have the lender give me a loan estimate, and then I'll give that loan estimate to another lender with another institution, and I'll have them compete with each other. Luckily for me, I know hundreds of lenders because I'm in this industry, and they happen to be both one of my friends. I just told them up front, listen, I'm gonna have you guys compete for my loan because I don't wanna pay more than I have to. So it's very common to do that, and you actually should do that. Turns out that lenders do have some wiggle room in the loan, in the interest rate, and in the fees. And depending on your credit standing, having them compete with each other will usually get you a little bit of a better deal. It's not like the car industry where they can absolutely slam you with a ridiculous interest rate. There's just a little bit of play depending upon a lot of different factors. Another way to lower the cost of your refinance is to buy down your loan with discount points. In many cases, when it comes to refinances, lenders will offer a no closing cost refinance situation. How does the lender pull this off? Well, they're gonna roll in your closing cost into your mortgage, which, depending upon a lot of different factors, may or may not make sense. The reason it wouldn't make sense is because you're paying interest on top of interest. You're essentially taking closing costs you could have paid cash for, you're rolling it into a loan that you're already refinancing. So it does make sense sometimes, and sometimes it doesn't make sense. The biggest way that you could reduce the cost of your refinance is to make sure that you work on your credit before you refinance. Make sure that you get your credit standing and your credit scores up as high as you possibly can before you decide to go in and refinance. Your credit utilization is worth around 30% of your score, and a lot of people go into a refinance situation because they're trying to cash out money from their home, but they've already maxed out their credit cards. And that severely cripples them when it comes to fees and interest rate, where if they just had those things paid down, their credit scores would be much, much higher.